Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines, everyone. So, it is December 29th, the final Monday of 2025. And we are looking at, just a huge stack of sources today.
It's a big one. We've got Yahoo Finance, CNBC, Reuters, Bloomberg, CNN.
All of them telling this really complex story. So our mission for this deep dive is to kind of unpack the single defining tension in the market as we head into 2026.
And that tension is, well, it's a real tug of war.
Exactly. You've got this immense centralized growth from AI on one side.
And on the other, you have this massive decentralized fragility. Geopolitical, monetary, you name it.
You really have to understand both sides of that pull to navigate what's coming.
That's the perfect way to frame it. I mean, we're closing a year where the S&P is up over 17%.
Which is incredible.
It is. But just beneath that surface, the very bedrock of finance, you're talking the Fed, the bond market, even our energy grid, is showing cracks. It's fracturing.
So we need to help you separate the signal from the noise, what's really driving these historic highs, and, what could make it all just seize up.
Go ahead.
Okay, let's start with that unstoppable force, the AI boom. According to Yahoo Finance, stocks are just roaring near record levels.
They really are.
The S&P 500 closed Friday at 6,929.94, gained 1.4% just last week.
But the real story of the year, the whole year, has been tech.
Oh, absolutely. The XLK, that's the tech ETF, has jumped an astronomical 26%.
And that 26%, that's where the anxiety comes from, right? The bubble talk.
Of course, you see gains that concentrated, and you immediately think .com bust.
But here's the thing. The critical synthesis from Wall Street right now, what most analysts seem to agree on, is that it's not an immediate bubble.
Okay, so what's their justification? Because, looking at NVIDIA with a $4.6 trillion market cap, that feels very bubble-esque.
It does. It feels like it. But analysts from Goldman Sachs and UBS, they're arguing that these aren't gains built on, pure hopeful speculation.
Right.
They're built on real, robust earnings growth. Strong balance sheets. If you actually look at the forward price to earnings multiples, they're only marginally higher than they were at the start of the year.
So the math, for now, actually supports the prices.
The math works because the expected future cash flows are just so enormous.
But if we look back at history, right, the late 1920s, the late 90s, the structure always felt sound right up until the moment it wasn't.
That's the danger.
I keep thinking about that one strategist who said the current pattern looks eerily similar to those past cycles. He saw a bubble coming, but not until, 2029 or 2030?
Exactly. And that's the contradiction. It's fundamentally solid today, but structurally it's building towards something that might not be sustainable a few years from now.
So the structure is what's unsettled.
That's it. And that's why you see these wildly bullish long-term forecasts. UBS and Ed Yardeni are looking at the S&P hitting 7,700 next year.
7,700.
And they're factoring in not just AI investment, but also these new fiscal tailwinds from the One Big Beautiful Bill Act.
And sanctuary strategists are throwing out even bigger numbers, like 10,000 to 13,000 by 2030.
That level of confidence, it's all rooted in the infrastructure of AI.
And that infrastructure is chips. It all comes back to chips.
Yeah.
Yahoo Finance highlighted how that whole sector has just completely changed.
It's a total transformation.
Yeah, they used to be these cyclical commodity plays, but now everyone treats them as pure growth engines.
And that transformation is entirely focused on one thing: building out data centers. NVIDIA is still the titan here.
The one rewriting the path for chips, as the source said.
That's the quote. They're up over 40% this year. They even briefly crossed $5 trillion in valuation. And then there's that massive $20 billion licensing deal with Grok.
I thought that Bank of America analysis on this was really instructive. They're forecasting the whole semi-sector will top $1 trillion in annual sales in 2026.
$1 trillion. And they believe we are still only at the midpoint of a decade-long AI transformation.
So the big money is still on the table.
That's what they're suggesting. And their strategy is really clear, very concentrated. It's basically buy the top 5 companies sorted by gross margins.
And that list was NVIDIA, Broadcom, Lam Research, KLA.
Analog Devices and Cadence Design Systems, yes.
But isn't buying the top 5 by gross margin just, chasing momentum? What about diversification? What if AI spending slows down even a little bit?
It's a calculated bet, a bet on indispensability. Baltha's thinking is that big tech has to keep investing in this hardware.
Defensively and offensively.
Right, regardless of short-term economic hiccups. And these companies, with their margin structure, are in the best position to capture that spending. It's a high-conviction trade. Without these chips, the AI future just doesn't happen.
Okay, so let's pivot from that concentrated power of tech to the very fragmented world of macro policy. The transition is natural, right? AI's success depends on a stable financing environment.
Which brings us to the deeply divided Federal Reserve.
Deeply divided is right.
The reports from Yahoo Finance, they detail a level of division we haven't seen since the painful stagflation of the 1970s.
Their dual mandate is just fundamentally clashing. Maximize employment, which is softening,
Unemployment is at 4.6%.
versus keeping prices stable when inflation is still stubbornly above their 2% target.
And the policy paralysis is what's so fascinating. The Fed pushed through 3 insurance rate cuts this fall, but that last cut in December saw a 3-way split in dissent.
That's almost unheard of. It wasn't just Hawks versus Dove.
Not at all. You had Goolsbee and Schmid, who wanted to hold steady because of inflation. But then on the other side, Governor Miron wanted a bigger 50 basis point cut to help employment.
It tells you the economic picture is so muddy, nobody can agree on the path forward.
And then there's a political angle. Stephen Miron, the former White House CEA chair, his appointment as a Fed governor is still fueling these concerns about political influence.
So looking ahead to 2026, they're signaling extreme caution.
Extreme caution. Maybe only one more rate cut next year. They're favoring what they call a look around and take stock approach.
And Cleveland Fed President Hammack, who will be a voting member, is already backing that up.
Yes, he's favoring steady rates until at least the spring. The Fed is just being super cautious, partly because their own data got so skewed by the government shutdown earlier this year.
And this caution, it feeds directly into the U.S. debt problem. Reuters describes the $30 trillion U.S. bond market as being in a fragile truce with the administration.
A very fragile truce, especially after the revolt we saw following the Liberation Day tariffs back in April.
Right. The market basically panicked over the unpredictability of it all. So Treasury Secretary Scott Bessent is just trying to manage that fear.
He's focused on keeping that 10-year yield in check. It sets the benchmark for everything. Today, Monday, it slipped just 2 basis points to 4.112%.
So how are they managing this huge debt pile? The deficit is still around 6% of GDP.
They're being very tactical. Instead of issuing a lot of long-dated bonds, which have inflation risk.
They're leaning heavily on short-term T-bills.
Exactly. And what's fascinating is that this strategy is finding new buyers in stablecoin issuers.
Stablecoin issuers.
Yeah, they have to back their crypto products with these super liquid short-term instruments. So in a weird way, crypto demand is helping to finance U.S. debt.
That is a strange symmetry. But relying so much on the short end of the curve, that's risky, isn't it?
It's absolutely risky. Sources point out that if that niche demand falters, or if inflation is stickier than we think, the Treasury could face a sudden refinancing crunch.
So they're trading long-term rate risk for near-term refinancing risk.
That's the trade-off.
Meanwhile, the housing market seems completely stuck. Yahoo Finance says mortgage rates are trapped in this narrow 6.2 to 6.3% range.
And they've been there since mid-September, despite 3 Fed rate cuts.
It's counterintuitive.
It is. Just reflects all these mixed signals. The weak labor market, but still high inflation. The risk premium is just stuck. Forecasters are basically resigned to seeing rates in that 6 to 6.5% range next year.
But the real tipping point, the number that could unlock everything, is getting into the high fives, even 5.99%.
That's the magic number. That's what you need to watch for any real shift in housing.
Let's move on to some major industry pivots, starting with, a huge reversal from the big 3 automakers.
Backing away from EVs.
Yahoo Finance called it perfectly. 2025, the year the big 3 backed away from EVs. So what's the strategic cost here?
Well, the short-term cost is astronomical, but Wall Street actually welcomed the move. Ford made the biggest change.
Pivoting hard to hybrids and EREVs.
Right. And they canceled the current Lightning pickup and a new 3-row SUV. That cost them a staggering $19.5 billion charge.
Wow.
But the consensus was it was a decisive move. Cut your losses early, prioritize financial prudence over hitting electrification targets.
So stabilizing margins now, even if it delays the green transition.
That's the play. GM took a smaller but still big $1.6 billion charge and did the same thing, promising hybrids after saying they'd skip them.
And Stellantis is going even further back to gas engines.
They're betting big on ICE, delaying the Ram Charger, bringing back the Hemi V8, and committing $13 billion to 5 new gas models.
It really feels like a collective decision to embrace flexibility. But how vulnerable does this leave them if EV demand suddenly surges later on?
And that's the long-term strategic cost they're accepting. Analysts agree that while ICE will be around longer than we thought, the automakers could be caught completely flat-footed if policy or consumer demand shifts quickly.
They're trading future preparedness for current profit.
That's it, is exactly.
And this whole shift leads right back to the biggest constraint on everything, energy. CNBC reports Europe is at a fork in the road.
They have to choose. Compete in the global AI race or stick to their climate goals. They can't do both.
The conflict is that profound.
It is. Global data center energy demand could jump 3.5 times by 2030. Europe planned for renewables to replace fossil fuels, but now all that new green power might just get sucked up by data centers.
Forcing them to keep the old plants online longer.
Exactly. And you're already seeing commitments being watered down, delaying the emissions trading system, softening the combustion engine ban.
And the infrastructure just isn't there. In the UK, developers near London are being told it's an 8 to 10-year wait just to plug into the grid.
Which is why you're hearing these radical, almost sci-fi solutions being proposed.
Like data center spas.
Using excess server heat for local communities. And even the wild idea of servers in space.
Google and NVIDIA are exploring orbital data centers.
We should just pause on that. We've had to stretch our imagination that far to solve an energy problem that's caused by a calculation problem.
It feels like a long way around.
It is. And while those ideas are exciting, the financial reality for you is that experts say they're not feasible until maybe 2055 or later. The cost and complexity are just phenomenal.
Okay, let's look at AI's impact on the consumer side. We're moving toward what CNBC is calling agentic commerce.
This is a huge shift. Visa and MasterCard are already piloting this, and they see it as a reality as early as 2026.
So this means your AI assistant, like ChatGPT or Gemini, will just do the shopping for you.
Completely. It discovers products, compares deals, books flights, and pays for it all within the chat interface. We're moving from e-commerce to intelligent commerce.
That sounds amazingly simple for the consumer. But who's liable when AI messes up? If I ask for a red bike and it buys a blue one, who takes the hit?
That is the single biggest structural issue they're trying to solve. The traditional payment chain has 4 parties. You, your bank, the merchant, and their bank.
And this adds a 5th.
It inserts a new, autonomous 5th player, the AI platform. So if the agent makes a mistake, the whole system, which is built on decades of rules about fraud and liability, it just breaks down.
So is it my fault? The merchant's fault?
Or is the AI platform now a fully liable entity? They're still figuring that out. It's way more complex than just a new checkout button.
Okay, let's turn to global flashpoints, where all this anxiety over debt and stability is really showing up. We have to talk about precious metals. Everyone watches gold.
Which had a fantastic year, up 70%.
But Bloomberg reports that silver has completely stolen the show.
Silver surged to a record high above $80 an ounce. That's almost triple its value from a year ago.
And this is driven by a perfect storm.
It's everything. You have structural supply tightness demand has outpaced output for 5 years. You have its critical use in solar panels and EVs, so it's a green tech metal.
And on top of that, you have the debasement trade investors fleeing government bonds and just pure speculation.
Exactly. The market is much thinner than gold, so it's more volatile. We saw that when the price jumped after an Elon Musk social media post about Chinese export restrictions.
Even though the restrictions weren't really new.
Right. The market is just that febrile.
And on the geopolitical front, we saw that fragility hit defense stocks. CNBC reported that companies like Rheinmetall and Leonardo all slid last week.
They slid on news of progress in the peace talks between President Trump and Ukrainian President Zelensky.
The market sees peace as bad for business.
Well, it means less demand for new defense spending. The reporting suggested they're very close, like 90 to 95% of the way to a deal.
But there are still a few thorny issues left.
Likely related to territory, which is what's holding up the final agreement.
Okay, finally, let's tie the AI boom back to the physical world, to the reality of resources. And that brings us to Kiruna, Sweden.
This story from CNBC is incredible. It really highlights the cultural cost of this whole transition.
They're literally moving an entire city.
A multi-decade transformation. They're moving thousands of residents, historic buildings like the 113-year-old Kiruna Church, all because of ground subsidence from the world's largest underground iron ore mine.
And the reason for all this disruption?
LK, the state-owned mining company, just discovered one of Europe's largest deposits of rare earths right there.
Which are essential for EVs and wind turbines.
That's absolutely essential. The municipal chairman told CNBC, and this is chilling, that every resident in Kiruna knows that we have to move because they live on the minerals.
So the cost isn't just financial, it's cultural.
Deeply cultural. It's affecting indigenous Sami reindeer herding. Even the microclimate of the new city is colder. It's a heavy price to pay.
A very heavy trade-off. Let's touch quickly on commercial real estate, where Starbucks is reversing course. CNN reports they're retreating from cities.
Yeah, they're closing hundreds of underperforming stores in places like New York, LA, Chicago. Their old strategy of a Starbucks on every corner just backfired.
Because of rising costs and, crucially, remote work.
Right. The commuter and office traffic dried up. So the new CEO, Brian Niccol, is repositioning them, expanding in the suburbs, focusing on drive-thrus where costs are lower.
It's just more evidence that the post-pandemic landscape is all about decentralization.
And that's the tension we wrap up with, isn't it? The market is being pulled between this undeniable earnings-driven AI surge
Which justifies the high valuations, for now.
and these massive structural headwinds. A divided Fed, chronic debt, energy constraints, and the immense physical toll of just getting the raw materials.
The technological build-out we've discussed, it's relentless. We're even seeing NASA, funded by that One Big Beautiful Bill Act, planning moon bases to mine helium-3 for some orbital economy.
It sounds like science fiction.
It does. But how do we as a society balance that immense sci-fi potential of a space-based future with the immediate tangible disruption felt right now by communities like Kiruna, where a whole city has to move just to get the materials needed for that same future to exist here on Earth? That's the question that defines the next decade. We'll see you all tomorrow morning with new headlines from major financial magazines.